November saw the US edge closer to some meaningful tax reforms, and the prospect of lower tax rates driving US corporate earnings higher was enough to see the S&P 500 index end the month up. This was the 13th consecutive run of positive monthly returns for the US stock index, the longest streak ever. Outside of the US, most other stock markets were weaker, with Europe's stock market index experiencing their worst month for the year. Japan was the only other major economy with a positive stock market return in November, but that, combined with strong US returns, was enough to see the MSCI World Equity Index up for the month. It too is experiencing its longest ever sequence of positive monthly returns. In emerging markets, a weak US dollar, stellar returns from Chinese IT companies, and positive South African stock market returns were enough to keep the MSCI Emerging Market Index marginally positive for the month, in spite of negative performances from all other major EM stock markets. US tech companies had been responsible for half of the S&P 500 returns through the end of October, but they were the second worst sector in November. Consumer stocks, and particularly some of the beaten-up retailers, were a key driver of US stock market returns in November. Companies like Macy's and Foot Locker showed initial signs of some success in fighting back against the online shopping trend that's been shaping the US retail shopping landscape recently. Bond yields were largely unchanged for the month, and though credit spreads also ended the month largely unchanged, this was only thanks to a strong late-month rally. Early in the month, the announcement of some merger activity was enough to spook the corporate bond market, which is trading near the highs of the previous bull market. If you have any questions on this or to invest with Anchor, please contact us on sales@anchorcapital.coza or visit our website www.anchorcapital.coza.